Let's talk about liquidity. It's one of the most frequently invoked, yet I think, misunderstood concepts in all of modern finance. You hear it all the time, right? Markets are described as liquid or illiquid. Banks are said to provide liquidity. And central banks, well, they inject it during a crisis. But what does the term actually signify?
So this is the core question we're going to address today. We're going to dissect this concept to really get at its structural importance in the architecture of the financial system. We need to move beyond those surface-level definitions to understand its fundamental role in both stability and, yes, fragility.
To begin, we have to recognize that the term liquidity isn't just one single simple property. Its common definition, while useful, is really just a starting point for a much deeper and frankly more consequential analysis.
This is the understanding that's most familiar to people. We call this market liquidity, and it all has to do with trading conditions. Can you execute a transaction immediately at a stable, predictable price? In a highly liquid market, the answer is a clear yes. But in an illiquid market, well, attempting to sell quickly forces the price down.
But you see, this initial definition is critically incomplete. If we only focus on trading conditions, we're missing the other half of the story, and it's the half that relates directly to institutional stability and the very mechanics of financial crises.
So here, the concept splits into two distinct but deeply related forms. One concerns the markets themselves, and the other concerns the institutions that operate within them. Okay, so on the left we have market liquidity, which we've just discussed, but on the right we have funding liquidity. And this is an entirely different concept. This is all about balance sheets. It's an institution's ability to meet its short-term obligations, like a bank honoring deposit withdrawals or a firm paying its immediate bills. It's really a measure of solvency in the immediate term.
Now, the crucial insight isn't just in these definitions alone. It's in their powerful and often dangerous interaction. The health of markets and the health of institutions are inextricably bound together through this channel of liquidity.
And this interaction, it can build into a really powerful feedback loop. During periods of financial stress, the connection between funding and market liquidity can create a self-reinforcing spiral that can destabilize the entire system.
Let's look at the mechanic here. It begins when funding liquidity tightens. Lenders get nervous. This forces institutions to sell assets to raise cash. But when many institutions try to sell at once, market prices fall, which means market liquidity has just evaporated. This fall in prices then reduces the value of the very assets being used as collateral, which prompts lenders to demand even more collateral or tighten funding even further. And there it is. A funding problem has just become a full-blown market crisis.
And this leads us to the core conclusion of all of this. Liquidity is not some fixed external feature of a market, like the weather. No, it's endogenous. It's created and destroyed by the collective actions of market participants. Think about it. In a crisis, the very search for liquidity by individual firms is what destroys it for the system as a whole. So as you can see, liquidity is not some physical property of an asset, it's actually a fragile state. It rests on expectations about the future, on confidence in the ability to secure financing, and on the strength of intermediary balance sheets. And its most defining characteristic is its tendency to disappear at the exact moment it is most needed.
So this leads to a crucial point. If liquidity is not guaranteed, if it can just evaporate, then it must be treated as a fundamental risk. And in the world of finance, risk always requires compensation.
What this means is that assets that are more likely to become illiquid during a systemic downturn simply must offer a higher expected return. Investors demand a premium for bearing the risk that they might get trapped in a position, unable to sell without taking a catastrophic loss.
And ultimately, this means liquidity risk is not just some small nuisance. It is a systematic risk factor that is priced into assets, just like market risk. The expected return of an asset depends not only on its fundamentals, but also on its expected behavior during a liquidity crisis.
This insight really represents a significant evolution in our understanding of asset pricing. The classic view held that an asset's risk was just its correlation with the overall market. The theory then expanded to include exposure to the health of financial intermediaries. But now we see a more complete picture. Systematic risk is a function of an asset's exposure to the market, to intermediaries, and to the state of liquidity itself.
So to synthesize this entire argument, liquidity is far more than a technical feature of trading. Its abundance or its scarcity is a primary indicator, a state variable, if you will, that describes the overall health and fragility of the financial system. When liquidity is abundant, risk seems low, But when it contracts, the underlying risks suddenly become very visible.
This brings us to the next logical structural question. We've established that liquidity is tied to the balance sheets of financial institutions. Well, this naturally leads us to consider the role of leverage and how it acts as a powerful amplifier of shocks, turning what might be small disturbances into system-wide dislocations. We'll explore that in our next explainer.